Greetings, Jonathan Camarda, your humble CIO. So we'll get right down to it. Last week, obviously, the roughest week of the year. After the week before, we had pretty hot PPI and CPI data come out. Now there's rumblings with the Fed, certain Fed members, voting, non-voting, I don't keep track anymore, that they'd wished and hoped for 50 basis points rather than the 25 that Jerome went with last time. Of course, Jerry did kind of give a disinflationary tone last time, and that was before some of these hot numbers. All started out with those job numbers from a few weeks ago, which we will go back into those again. You kind of have my thoughts on that. Now, this past week, the Fed's favorite data point was the PCE, the personal consumption expenditures, which was the highest rate that they were since last June. So this was pretty shocking. But again, it kind of fits in with the increasing costs, right? Input costs, manufacturing costs, everything going up. We went over inflation data on, certainly groceries and products last week. So these numbers are coming in hot. So now the fear is the Fed may go 50 in March, and then another maybe 75 to 100 basis points on top of that later. So instead of getting to 5 3/4 as their projected rate, maybe 6 now you're starting to hear. So this has put pressure on the market. So the wrecking ball, otherwise known as the U.S. dollar, has woken up from a slumber, although it's still got some headwinds ahead. We'll be watching that. Same thing with volatility. We watch the VIX here, as you know, with options as well. Put the call ratios are pretty much in moderate range now. So it's very interesting here as everything is being run now by the fear of an over-hawkish Fed to stomp this persistent inflation out, which it'll definitely take a long time. But the big point is the pivot hopers, the folks that were hoping that the Fed would start decreasing rates later in the year, again, probability has diminished. So what does this set? We're looking at earnings that have been okay, a little under 70% have beat earnings, although projected, forward-looking guidance has been going down, as well as earning multiples, growth rates and as such. However, a lot of the beaten down stocks of last year have certainly been the strongest rebounders this year, not last week notwithstanding. Going forward, you still have some of the global institutions that are still looking for growth to be more resilient as we move through the year than value. So that belies the face of being very defensive with where the market has been over the last week on somewhat shaky ground. So where does that leave us? Well, right now, the positive, the silver lining in the cloud is that small and mid-cap stocks, generally which outperform when projections for growth are higher, have been doing just that, hanging in tougher than the S&P, NASDAQ, and the Dow Jones. So interesting to watch that dichotomy as, again, after a pretty bad week last week, after a pretty decent start to the year, and now hotter numbers, definitely shed a gray area over strategy. So lastly, that's what we'll finish with, right? What is the strategy? Well, you'll notice in your active capital preservation, we've increased interest rate bullish positions and U.S. dollar positions. Bonds are kind of in that middle range, so we do have some fixed income exposure as well. And equities, again, on your trading strategies and your opportunistic growth and income dividend strategy, we remain pretty poised in long positions. Now, that could change at any time, but the markets are holding at pretty significant levels. For the Russell, it's at the 50-day moving average, pretty strong. The other indices kind of clinging in between, or the 50 and the 200-day moving averages hanging on there on those threads. So we have to be driven by, again, the data, not projections, and certainly, maybe oversold weeks like last week. Everything can change even this week. So stay tuned, stay frosty, and until next time, we will be eternally vigilant. Thanks again for your time, patience, and most importantly, your trust. Until next time, Jonathan Camarda.